because I think a lot of people, they're going to listen to this, don't know what you do, right? So maybe give a really quick kind of, give 30 seconds to a minute. What is your job? What do you do as a profession?
Yeah, so I'm going to first start with Jefferies. We're an investment bank, a global investment bank. And the simplest way to think about what we do is we connect capital to ideas. So we work with companies that need money, and we have investors that have money. And our job is to broker those relationships. And we work on Wall Street. So every day we get to watch this crazy market dictate what the value of companies is, higher or lower. And the great joy I have is to be a consumer analyst. So I get to connect a bit of consumer psychology to decisions around company strategy, risks and opportunities, M&A in terms of buying and selling companies, buying and selling brands. So it's a fun role. I get to do what I love, which is track consumer interests, and then I get to translate it into business strategy and opportunity and valuation.
Awesome. Well, that's why I brought you on, right? Because right now markets are getting a little crazy, a little squirrely. So
Right.
I was compiling some numbers, and they were even surprising to me, even though I knew they were bad. So Amazon, in the last 6 months, Amazon down 39%, Nike 38%, negative 38, Macy's negative 46, Google negative 25, Facebook negative 43, Target negative 37, Lululemon negative 40%, Nordstrom negative 35, LVMH negative 28, Revolve negative 66, Stitch Fix negative 71. I think the direct consumer brands that have gone to market have really gotten hammered the worst. So tell me, based on your understanding of kind of historical downturns, so if you're to look at 2000, 2008 were the last two really big ones, are we in one? Number one, do you think we're in one right now? Is that happening? If so, like how long do you think that will last? And how do you see that impacting kind of the retail and consumer industries over that time?
Yeah, it's a really good question. And it is staggering to see those numbers and realize that the public market has essentially said that Nike is worth 38% less. Those are big haircuts to valuation. So I think part of the reason that the cuts are so dramatic is that the market is starting to price in a recession. The market is starting to see signs that the consumer is receding. I am not an economist. I am not going to declare a recession. But when we look at behavioral change, we're seeing the consumers making some discriminate changes in how they're behaving that would suggest that they're a little bit less financially confident about their ability to digest inflation. So whenever that happens in the public market, it's effectively a shock to the assumptions that we all had. All the things we thought were true, we now have to go back and reconsider and rethink. And what investors tend to do is they tend to like to manage from risk up. So they go and say, what's the most risky, lowest level that I could think is even possible, and then work my way back up into what's reasonable. And right now we're in a period of everyone's trying to assess how bad and how long. And I think there was some concept of maybe how bad, but then most recently we got Amazon that reported their earnings, Walmart that reported, Target that reported, Kohl's, and it's been worse than anybody expected. So that's creating an incremental shock. The degree of pressure on these businesses and the comments that the companies are making about the pressure on the consumer are more exaggerated than what was expected. And how long it lasts is also coming into play. Short cycle recessions tend to last 6 to 8 months. If you look at long cycle recessions, it can be 2 to 3 years. So right now we're in a phase of not knowing how long. And when that happens, everyone again goes to how much risk do I have exposed right now, and how do I mitigate risk? And so there's just a very clear exit of capital from the markets, and that's what's creating these substantial compressions in stock performance. It's scary. It's scary every day to see the level of reaction. And it's not any one thing that's creating the concern, but it's a mountain of things that are building up that are really challenging things we thought were certain that are becoming more uncertain.
Yeah, I think one of the things that's been surprising to me as a relative outsider, right? Because I'm not looking at it in the same way that you're looking at it on a day-to-day basis, is, the sentiment I was seeing was that, in a lot of ways, consumer demand is still there, right? Like for a lot of things. And so, there's high employment, high demand, right? But we're still seeing these shocks. Like it's a little it doesn't make a lot of sense to me. How do you make sense of that?
Yeah, and it's a great observation, Connor, that the data points aren't consistently negative.
Yep.
So when you look at some economic measures, they would say, well, the consumer balance sheets are healthy. People have been saving over the last couple of years. The high-end consumer hasn't been spending on services and leisure and travel. And so there's a lot of pent-up demand for those kinds of things. And on the low end, we've never seen unemployment levels with this kind of wage rate advancement. And so the low end should feel extremely wealthy on a relative basis. And so they've got plenty of cash to spend. What in reality, though, is happening is that even on paper, when it looks like the consumer is healthier, the way the consumer shows up at retail is based on a feeling, how they feel. Do they feel more financially confident? And if the low-end consumer has wage growth in the double digits, but now inflation is in the double digits for them, they don't feel wealthier. And so they make decisions based on feeling and the psychology of consumerism more so than the financial algorithm. And the same is happening at the top end. Even though the high-end consumer has ample capacity to spend, they're pivoting. They're moving from goods, very goods-heavy economy over the last couple of years, into services and leisure. And so there's some motion at the upper end. And regardless of how much you make, when it costs you 20, 30% more to fill up your car with gas, you're just kind of irritated. So there's a little bit of a psychological bitterness at the upper end. That also affects psychology. So we don't disagree with the economists that on paper, the consumer should be fine. But what we see behaviorally is when the consumer shows up at retail, they don't feel fine. And that feeling is what's governing their actions right now. There are some other signals. Delinquency rates in the credit profiles are starting to rise up. We're starting to see some changes in consumers' perceptions about persistent inflation. So while it may feel like inflation has peaked, there's still more inflation to come. The Fed headlines in terms of how hot the economy is running and how they might have to cool it down. And I think there's a fear out there that if we do get into a true recession, that business investment and employment is going to start to unwind. And so then you're also going to have a secondary factor, which is that the employment market starts to destabilize. So all of these things are floating through consumer psychology. They're all floating through investor psychology. Investors just have a way every day to take action against that psychological uncertainty. They go to the market and they sell stocks. Or consumers, you can't go to the market and sell your food or sell your goods back. So you just buy less the next time you go.
Yeah. And I think, we talked about this in Miami just last week. And one of the comments that stood out to me that you mentioned is like, fear is a weird thing, right? So we've got a lot of people that are looking at their retirement funds and watching them drop and drop and drop and saying, hey, you know what? Even if I have to take a 20% haircut, at least I've got it. And like, I don't have to worry about it anymore. And I feel like that's, it's obviously like a really big deal, right? That's a big part of it for sure. So I guess go ahead.
Sure. No, I was going to say you're onto something. I think the idea of fear is often paralyzing, but it's certainly unnerving. And I think that's a little bit of what we're seeing. It's just an unnerved consumer, not feeling entirely confident, at least not as confident as they were even just 90 days ago. And inflation's a big piece of that. I mean, when people are seeing the cost of food and fuel going up double digits, those are every week purchases. And so it's just a constant drumbeat, a reminder. And it's psychologically stoking that uncertainty. And so we did a survey recently of consumers, and having done surveys over 20 plus years, it's pretty rare to see a consumer base that you survey agree with something in such magnitude that we saw with respect to how much more inflation is likely to come. More than 75% of consumers in our survey thought that there is still more inflation to come. And so magnitude of sensitivity around pricing to us, and that was regardless of income cohort, 100K plus all the way down to 45K household income, there was a belief that more inflation is still to come. So they're also making purchase decisions today, knowing that in the future, those products are going to cost more and being conscious of that.
Yeah, I mean, I think there's some logic like if you think there is going to be inflation, there will be inflation, right? Because you say, hey, okay, well, I'm repricing this contract. Okay, now we're going to price it based on what we expect inflation to be, right? So before it would increase by 3% a year, now we're going to increase it by 7% a year, right? And so some of it just happens because it's happening, which is probably the worst part, right? So once it's kind of broken through and become like, oh, no, 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 this is just how it is, it actually becomes harder to bring it back, right?
Very true.